Hello and welcome to the Leaky Bucket podcast. I'm your host, Ian Morgan, and I'm here to make accounting fun and practical. With over 15 years of experience as an accountant and a business owner, I'm excited to share tips and tricks that will help you improve your financial controls and gain the clarity that you need to succeed. So let's plug those financial leaks and take your business to the next level. Stay tuned for some great insights. Hey everybody and welcome back. I'm Ian and today we're going to be diving into a crucial topic for UK company directors and shareholders, and that is what is the most efficient way to pay yourself in 2024-25. And this information is essential for maximising your income while minimising your tax liabilities. Now, I know that it's some way into the tax year, but recently we've had some conversations with some new potential clients and they've mentioned that they're not aware, or it certainly became obvious that they're not aware how to best pay themselves. So I thought I would basically come on here and share my thoughts on the topic. Now, first thing first, we need to cover off a little bit of an explanation. A key part of the strategy is using dividends to pay yourself. Now, dividends are payments that are made to shareholders of a company. Now, a shareholder is not necessarily a director, although they can be, right? But they're payments that are made to shareholders from the company's profits. They are distributed, however, after the company has already paid its corporation tax. So dividends are not going to reduce the amount of tax that the company pays. They're also taxed completely differently from salaries, but they often result in much lower tax liabilities for the recipients. Now, before I really get into this, I want to make it clear here that any of the advice that we give within this content, it may not be suitable for everyone. If you're a sole director or shareholder with no staff, then there are certainly some tweaks that are needed to the information that we give. If you've got any other income sources, such as additional business income, whether that's through limited companies or through partnerships or through self-employed businesses, if you've got property rental income, any other dividend income, any pension income, salary from another job, or any other income of any sort, then you should definitely seek tailored advice. The advice within here is general guidance and is suitable for most circumstances, okay? But tax is complex. So when in doubt, always seek the guidance of an accountant or a tax professional. Now, so to be clear, this guidance then is basically for limited company director shareholders who have at least got one member of staff in addition to themselves, and this is their only source of income and they're based within the UK. Right, now we've got that out of the way, we can now have a look at understanding your options. So there's three main strategies, in my opinion, to consider, and each has got its own tax implications and benefits. Strategy number one, pay no tax. Personally, don't forget, companies already paid tax here. So this strategy here allows you to receive income without paying any personal tax. You set your salary to the personal allowance threshold. That's roughly around £13,000. And then you balance your income with dividends, ensuring that you stay within the tax-free limits. Now, that tax-free limit of dividends that in previous budgets has been announced that it's being reduced. So you do need to just double check what they are at the moment. The great advantage of this is that you've got no personal tax liability. The con, however, here is that you've got really limited personal income. You're probably only going to be generating 14,000 or so pounds per year of total income, personally. Now, if that's enough for you to live and live a wonderful life, great. But If you're working full-time hours, that's going to be well below minimum wage. And therefore, I suggest that you probably need to review that. So we move then to the second strategy, and that is to make sure that you're only paying the basic rate of tax. This method here, this is the most common and efficient method for many, if not most, directors. So what you need to do first of all is you need to aim for a total monthly withdrawal of around £4,000. Some of this is going to be allocated as salary, right? Similar to the previous guide, right? So it's around about that £13,000 level for the year, okay? The other part is then made up of additional dividends. You need to allocate then, or put aside personally, around about £300 of that a month for tax. So you've paid yourself £4,000, some of it's salary, some of it's dividends. £300 is being put aside for tax. In this method, you're combining salary and dividends to optimize your tax efficiency. The pros here, right, are that you're getting a really balanced approach with a fairly moderate tax rate. You're also getting a higher monthly income compared to the no tax strategy. Yeah, you're getting yourself 3,700-ish a month after personal tax, which should give a fairly nice lifestyle. If you've got other directors, so if it's say like you're a husband and wife team and you've both got these circumstances open to you, then obviously that gives you the capacity to pay yourselves £4,000 each putting aside £300 for tax as well per month. To give you an idea, that example calculation, right, there's salary of £13,000 per year. There's dividends then, which is the balance paid each month to reach the £4,000 per month. And this gives you that really tax efficient approach whilst maximising income. Okay, so don't forget that's the most common approach. Strategy 3, this is the higher rate tax approach. And so this basically exposes you to higher rate tax, but you still retain your personal allowance. Okay, and this is really for those who need a bit of a higher income. So the £4,000 a month approach, that's not gonna give you the lifestyle that you want. But you don't want to be the case where you're really damaging your tax rates by losing your personal allowances. So in order to do this, you need to aim to withdraw around about £8,000 per month. Of that £8,000, you need to set aside £1,600 of that for taxes. By taking this approach, you maintain your personal allowance, but you're now mitigating the higher rate tax impacts of going over £100,000 per year. The pros here are that you're getting a much higher personal income than you were on the previous two levels. The cons, however, is there's quite a substantial jump up in your tax liability. Obviously, at the £4,000 per month level, you were putting £300 a month aside. You've doubled your income from £4,000 to £8,000 per month, but the tax has gone from £300 per month to £1,600 per month based on that jump up in the tax rates. Now, to give you that breakdown of that calculation, right, you're still going to be paying yourself the £13,000 salary per year. Well, yeah, it's the 12,570, right, if we're being particular over it. But to give you that guide, it's roughly the £13,000 per year. The dividends are there then to give you the additional top up to reach the £8,000 approximately per month. This then gives you that much higher income level whilst also still managing your tax situation. Now, there's a couple of other extra points here, right? We've got some considerations for higher income earners. So if you want to have earnings that are over £100,000 per year, then it's possible, but there's a few things you need to be aware of and look at. So if you go over there, you do start losing your tax-free personal allowance. That can mean not only are you paying tax at that higher rate, but you're also losing some of your tax-free elements. So the marginal rate or the effective rate that's happening in that gap between 100 and roughly £125,000, that rate is much, much higher. Then you've also got the fact that dividend income above that level is taxed at over 39% as well. So you need to carefully evaluate what the tax consequences are before opting to go to these higher income levels. And that's applicable for any of these, right? If you're choosing to stay, at the, let's say it's the £4,000 a month level, approximately, right? If you're staying at that level, that's what you're committing to. If you do £4,000 a month and then all of a sudden you go, I'm going to pay myself another £10,000 here all of a sudden, you've broken the plan, yeah? And you've moved yourself up as a category. And therefore you're having exposure to potential additional tax rates. Okay? The point is that this is about maintaining and giving yourself a regular income of which you can then budget personally. Then there's other bits as well. You can also look at setting up things like family investment companies or making pension contributions to mitigate any higher tax rates that you're also exposed to. There's a couple of other tax efficient strategies as well to be aware of. So national insurance contributions, the salary that we're talking about there, the 12,570 or the 13,000 approximate, right, that was leading to, that salary is there designed to specifically give you the best position for your national insurance contributions. So that one's already giving you a great advantage. Another tax efficient strategy is employer pension contributions. So contributing from your company into a pension scheme on your behalf, that can be a real big advantage, right? And it gives you some good long-term benefits as well. Then there's also tax-free benefits as well. So there's things like, you could be looking at things like company cars, medical insurance and childcare vouchers. Some of these things may be more advantageous to be putting through the company and paying the appropriate tax on those, as opposed to taking the money out and paying for them personally. The other things are that you need to be aware that you need to plan for any future changes as well. So you need to keep abreast of any changes in tax legislation that may affect your strategy. And you also need to make sure that you've got a regular review of your payment structure with your accountant. So remember that you need to tailor these strategies to your specific situation. Consult with your accountant or your financial advisor. If you're a client of ours, then reach out to your client manager and get personalized advice from them. And then consider having regular reviews to adjust your strategy based on your performance and any legislative changes as well. Obviously, if there's any legislative changes, we will make you aware of that if you're a client of ours. And also, we're regularly reviewing your strategies as well. So that's everything for today on the most efficient ways to pay yourself as a UK director or shareholder. If you find this information helpful, then please share and subscribe. And for more detailed advice, visit our website or book in a discovery call with us. Thanks so much for tuning in, and until next time. Thanks so much for taking the time to join us for this episode today. We will continue to bring you great tips and tricks in future episodes. But if you can't wait until then you can always head over to our Facebook group and join the conversation with fellow business owners and entrepreneurs. Just search Accounting Tips and Tricks on Facebook or check out the show notes. Until next time.